Hello, welcome from Trend Signal, where we review the data and events of the week beginning the 30th of October. Some big moves last week. Dollar definitely on the move. Equities, certainly in the US and in Europe, rallying further into new highs. A very big calendar week this week as well. More on that in a minute. We have European British winter time now in operation, so our clocks are 4 hours different from the US just for 1 week, when the US next weekend revert to their daylight savings, so the gap will go back to 5 hours, which is our usual difference. Markets last week, sterling markets were really hampered by really what the BOE is going to be doing this week, re-rates, and also issues to do with the upcoming budget. There's an article in the front page of the Financial Times, Hammond between a rock and a hard place in budget. This is with reference to the notion that he can't increase public spending without breaking his limits, budget limits, and if he's to keep his balanced budget target on track. So that's something he'll have to deal with. The DAX basked, I guess, in the weaker euro, really, propelling the big German exporters higher. And again, the DAX hitting an all-time high on Friday, really as a result of Mario Draghi and the ECB announcing the taper, which was slightly more dovish than what was expected, which caused the euro to fall quite significantly against the dollar, down about 170 odd pips on the week. Sterling actually fared better. The expectations from some media, certainly the BBC, trying to cool down our GDP reading last week when it came in better than expected, plus 0.4%. That caused sterling to rally quite sharply against all the majors, so it's only down 61 pips against the dollar on the week, a week when the dollar was definitely on the march, really. Let's have a look at the data this week. It's a pretty heavy schedule. Let's go to Forex Factory. Obviously, we've already noted the daylight savings shift, as the Americans refer to it. Nothing on Monday, certainly nothing noteworthy on Monday. We kick off Tuesday with one of the 3 central bank policy meetings this week. Bank of Japan, after the re-election of Shinzo Abe a week and a bit ago, the Japanese markets have powered ahead on the back of a weaker yen, consistently weaker yen, which is something that will please the Bank of Japan. We're expecting no change from the Bank of Japan. Other data out 2 o'clock. Remember, it's a 4-hour difference. The data that you're normally used to seeing at 3 o'clock, that'll be an hour early just for this week. Consumer confidence out at 2 o'clock, a good forward-looking indicator that could bolster the markets even further. We then jump to Wednesday, bank holiday in Europe for All Saints' Day, as the Europeans often have bank holidays in the middle of the week, something that we don't do here in the UK. UK manufacturing PMI data, even the media-bashed UK, the manufacturing sector is still expected to maintain a reasonably strong manufacturing reading, matching last month's number of 55.9, which was a bit weaker, but is still well ahead of the all-important 50 reading, which indicates an expansion. We got non-farm employment reading from the payroll data, ADP. It typically is particularly volatile and getting more so, but the hurricane warped data last month is expected to be adjusted in this month's reading of 191,000. Main event of the week, undoubtedly, is the FOMC. It would normally be that, but in fact, I'm sort of countering what I'm saying in a way, but the consensus is for no rate rise at all this meeting. The December meeting is when the markets expect rates to be pushed up by a quarter of a basis point, a quarter of a percent, that's 25 basis points. That's on Wednesday, the 13th of December. The probability of it happening then is 97%. The probability of it happening this Wednesday is pretty zero. So no change in rates this week whatsoever. Thursday, in a way, you could argue that this is probably more important for the global or international markets than the Fed. Here we have in the UK our MPC monthly policy meeting. That's combined with the inflation report and the minutes from the meeting all rolled out in one. We are expecting a rate hike of 0.25%, taking the rate back to where it was before the post-Brexit panic cut, you could call it. Quite interesting. There's a report, I heard it on the radio this morning, actually, that's Monday morning, about the percentage of mortgage holders in the UK that have never experienced a rate hike. And for the record, the last rate hike we had in the UK was in July 2007. Well, the answer is 42% of mortgage holders have never seen a rate hike. And that sounds as if it's something to get worried about, I guess, but I guess we don't want to get too excited about it for now because rates will still remain very low, and that's something that Carney, I suspect, will be keen to stress on Thursday when he has his moment with the media at 12:30 on Thursday. Of course, the debate rages about what happens after the rate hike with a slowing economy, depending on how much it is slowing, not as much as the BBC would have you believe. The advice from many is just one hike. The phrase "one then done" seems to be the phrase that people are rolling out. I think it all depends on the vote, how the vote goes. We expect a unanimous vote, but also what Carney says in the press conference at 1:30. So our markets will be particularly sensitive to that. And it's possible, the suggestion is that rates will then remain low for quite some time. And another comment that was I picked up on the radio on Monday morning was that in 1932 interest rates in the UK were set at 2%, and they stayed at 2% until 1951. So interest rates can remain at the same level for an extended period, and that really is extraordinary. I wouldn't have got that one right. Friday, before the sort of main event from the US with non-farm payroll, we got the services data here in the UK. The services sector, obviously, by far and away our biggest sector, dwarfing manufacturing now. But we're seeing another slip in that services sector, but still above the crucial 50 level. Onto the non-farm payroll. Seems that non-farm payroll sort of is starting to play second fiddle, really, to the FMC meetings now. We've got extraordinarily high rates of employment. The unemployment rate is particularly low, almost sort of at full employment, to the extent that you always have a natural amount of unemployment as people move jobs and the like. So we're expecting a correction, I guess it is, or an adjustment to the hurricane-infected data from October, which was down a loss of 33,000 jobs. We're looking for a significant rebound, which basically means that the number over 2 months is sort of a little bit roughly what was expected, perhaps a little bit lower. It'll impact all the markets, the US data, the non-farm payroll data, not just dollar-based ones, as the health of the US economy really is key to all the other developed economies and developing economies, I'd say. That's it. Thank you very much for listening. All the best. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.